April 2022. AT&T's board approves the unthinkable. They're selling Warner Media, HBO, CNN, Warner Brothers, Batman, Harry Potter, all of it, for $43 billion in cash. The price? Less than half what they paid just 4 years earlier. The stock price? Down 24% over 14 years, while competitors surged 85%. But here's the strangest part. AT&T's core telecom business was still making money. The crisis came from somewhere else entirely. This is the story of how one CEO made 2 catastrophic acquisitions that buried America's telecommunications giant under $180 billion in debt. Rewind to 2015. AT&T was a titan, $132 billion in annual revenue, over 240,000 employees, a profitable, stable telecommunications empire providing internet and phone services to millions of Americans. CEO Randall Stephenson had been at the helm since 2007, and by most accounts, he'd kept the ship steady. But Stephenson wasn't satisfied with steady. He had bigger ambitions. He wanted to transform AT&T from a simple telecom provider into a sprawling media conglomerate that could compete with the biggest entertainment companies in the world. His strategy? Follow Comcast's playbook. In 2011, Comcast had acquired NBC Universal for $30 billion. The move was brilliant. They could now offer what they called a triple play bundle: internet, phone, and television content, all from one provider. Customers loved it. They were willing to pay for it. The numbers told the story clearly. Between 2011 and 2015, Comcast's revenue grew 33.5%. AT&T only 15%, despite generating nearly double the revenue. Stephenson saw this gap widening. He knew he needed to act fast. Stephenson's response was simple. If Comcast could buy a media company and bundle television with telecom, AT&T would do the same. He targeted DirecTV, a satellite television provider. The logic seemed sound. Unlike cable companies, DirecTV didn't need costly nationwide wiring. Customers only needed a small dish. This made expansion faster and cheaper, especially in rural areas cable companies ignored. The upfront satellite costs were high, but once in place, DirecTV avoided the ongoing expenses of maintaining miles of cable infrastructure. For AT&T, it seemed perfect. They could offer internet, mobile service, and satellite television all at a competitive price. Better yet, they could upsell to their existing 120 million wireless subscribers. The potential seemed enormous. In 2015, AT&T pulled the trigger. They acquired DirecTV for $48.5 billion. Stephenson was glowing with optimism. In their annual report, he wrote that they had assembled all the pieces necessary to claim leadership as the top integrated communications company in the world. On paper, it all made perfect sense. Unfortunately for AT&T shareholders, this strategy had serious problems. When you look at the numbers, troubling patterns emerge immediately. From 2007 to 2010, DirecTV added about 2.5 million subscribers. Solid growth for a mature company, but over the next 5 years leading up to the acquisition, only 1 million subscribers. The growth wasn't just slowing, it was grinding to a complete halt. This should have been a massive red flag. Here's why. In 2015, the same year AT&T acquired DirecTV, Netflix had 70 million subscribers worldwide, including 17 million added that year alone. Its revenue had tripled since 2010. Streaming wasn't just growing, it was fundamentally changing how people consumed entertainment. Traditional television companies like DirecTV weren't merely slowing, they were being disrupted and replaced. Stephenson may have noticed this trend, but he clearly underestimated its impact. Netflix wasn't just an alternative, it was redefining the entire concept of television, and consumers were cutting the cord in droves to embrace it. So what actually happened after AT&T acquired DirecTV for nearly $50 billion? Initially, things didn't look too bad. AT&T's overall revenue increased after the merger. DirecTV even showed promising growth, expanding to 26 million households and briefly becoming the biggest television provider in the world. They had just overtaken Comcast's 22 million households. For a brief moment, it looked like Stephenson had made the right call, but this success was incredibly short-lived. The television services AT&T had spent nearly $50 billion to acquire weren't generating the profit margins executives hoped for. Operational costs were high, competition was fierce, customers were increasingly price-sensitive. Then growth didn't just slow, it reversed. Subscribers were leaving DirecTV daily, cancelling in favor of streaming services that offered more flexibility, better content, and lower prices. What had been a minor cord-cutting concern became a full-blown crisis. In 2016, AT&T launched DirecTV DirecTV Now, a hybrid streaming service combining traditional channels with internet delivery. The initial response seemed promising, 200,000 subscribers in the first month. But DirecTV Now offered the same content in the same overpriced subscription model customers were abandoning. In 2017 alone, DirecTV lost 1 million subscribers. Stevenson publicly claimed that gains from DirecTV Now would offset losses, but the streaming spin-off wasn't profitable, while the traditional service hemorrhaged customers. In mid-2018, AT&T raised DirecTV Now's price by $5 per month to improve margins. The move backfired. In Q1 2018, DirecTV Now had gained 340,000 subscribers. By Q3, just 49,000. Meanwhile, traditional DirecTV continued losing subscribers rapidly to Netflix, Hulu, Disney+, and others. The $48 billion acquisition, financed with massive debt, wasn't just failing to generate value, it was actively destroying it. With all of that context, what AT&T did next is almost impossible to believe. Instead of cutting their losses and refocusing on telecommunications, AT&T decided to double down on their media strategy. They had absurd levels of debt. Their television services were shrinking every quarter. The market was clearly moving away from their business model, but Stevenson decided to go all in. Near the end of 2018, AT&T made the biggest announcement in the company's long history. They had reached an agreement to buy Time Warner for more than $80 billion. When the dust settled, the final price tag came in at $85.4 billion, one of the largest acquisitions in corporate history. This merger was transformative in scope. Overnight, AT&T now owned Warner Bros. Studios, CNN, HBO, and countless other properties representing decades of entertainment history. They controlled Harry Potter, DC Comics including Batman and Superman, Looney Tunes, Game of Thrones, Adult Swim, Lord of the Rings. The list went on and on. Even with crushing debt from DirecTV, AT&T had transformed itself from a telecom company into a media powerhouse that could theoretically rival Disney. The question everyone was asking, whether this massive acquisition would save AT&T's rapidly sinking media empire, or whether they had just made their problems exponentially worse. AT&T might have suddenly owned more media assets than almost any other company on Earth, but they also had significantly more problems. For starters, the merger increased their total debt to $180 billion, an almost incomprehensible amount requiring billions in annual interest payments. This debt load would hang over every decision for years to come, limiting flexibility and forcing them to prioritize debt reduction over growth investments. But the debt wasn't even the biggest problem. The merger turned out to be a terrible marriage. It might have looked good on paper and in press releases, but it was fundamentally dysfunctional at its core. AT&T's corporate culture was deeply process-driven, bureaucratic, and slow, a structure that worked for a regulated telecom utility but was completely incompatible with fast-moving creative industries. This clashed head-on with Time Warner's culture, where decisions had to be made quickly to capitalize on cultural moments and entertainment trends. The merger looked shaky almost immediately. Investors made their skepticism clear. AT&T's stock continued a decline that had begun in 2015, wiping out billions in shareholder value, even after acquiring one of the most valuable media libraries in the world. At the same time, the streaming wars were exploding. Netflix and Hulu were established. Disney, Apple, Amazon, and others entered aggressively, spending billions to win subscribers. AT&T suddenly found itself in the middle of a brutal competitive battlefield without a clear strategy or the leadership needed to survive it. The situation worsened when Time Warner's top executives began leaving soon after the deal closed. Richard Plepler, the respected head of HBO, departed for Apple. Jeff Bewkes, Time Warner's longtime CEO, retired almost immediately. These were the leaders who understood entertainment and creative talent. Without them, AT&T was forced to install internal executives to run the media division. John Stankey, a longtime AT&T finance executive, was placed in charge. While highly experienced in corporate finance and telecommunications, he had little background in media, no deep creative relationships, no history of producing successful entertainment content. Despite spending more than $85 billion on Time Warner, AT&T seemed unsure how to use it. Rather than building a powerful streaming platform to compete head-on with Netflix, the company focused on bundling content to support its telecommunications business. HBO was pushed to release more content faster to boost subscriber numbers. This damaged its reputation for carefully curated, high-quality programming. At the same time, DirecTV continued to collapse. Its subscriber base fell from 26 million households to just 15 million by 2021, a loss of over 40% in only a few years. The larger lesson became painfully clear. You cannot acquire your way out of a fundamental strategic problem. AT&T had expanded into industries it didn't understand and moved from moderate profitability into sustained decline. In early 2021, Randall Stephenson announced his retirement as CEO. When he took over in 2007, AT&T's stock traded at nearly $40. 14 years later, around $30, a 24% drop. Over the same period, the S&P 500 rose 85%. AT&T shareholders had dramatically underperformed the market. Revenue in Stephenson's final year was $134 billion, actually lower than it had been before the Time Warner acquisition. Meanwhile, Comcast's revenue had surged 56% over the same period. The numbers told a brutal story. AT&T was shrinking, losing market share, and drowning under nearly $180 billion in debt. The damage could no longer be denied. The company desperately needed to regain control before the situation became unrecoverable. AT&T entered full damage control mode. The fastest way to stabilize the balance sheet? Asset sales. In April 2022, AT&T made its most painful move yet. It merged Time Warner, rebranded as Warner Media, with Discovery, creating a separate standalone company and fully spinning off the media assets it had spent $85 billion to acquire just a few years earlier. The deal delivered $43 billion in cash, money urgently needed to service AT&T's overwhelming debt. Attention then turned to DirecTV. AT&T sold a 30% stake to private equity firm TPG Capital, injecting additional cash while maintaining limited television bundles. Executives framed it as a way to stay competitive, but the reality was far harsher. Even after these moves, DirecTV's decline accelerated. In Q2 2022 alone, the service lost more than 400,000 subscribers, leaving just over 12 million customers. In 8 years, DirecTV had lost more than half of its peak subscriber base. Eventually, AT&T conceded defeat. It sold its remaining 70% stake in DirecTV, fully exiting the television business it had once bet the company on. The financial damage was staggering. DirecTV had been purchased for $48 billion in 2015. AT&T recovered only about $7.6 billion from the final sale. Roughly $30 billion was lost, not including debt financing costs, interest payments, or years of missed investment in core telecommunications infrastructure. This exit marked the end of AT&T's media ambitions. After shedding media assets and returning to telecommunications, AT&T finally showed signs of recovery. In 2024, the company's stock rose by 35%, its first meaningful rebound in years. Stephenson was gone. The media experiment was over. AT&T committed to rebuilding investor trust through $40 billion in stock buybacks and dividends. Even so, the company still faces a daunting challenge. It carries roughly $120 billion in debt despite all asset sales. Here's what other businesses can learn from AT&T's near collapse. Following your competitor's playbook doesn't mean it's the right strategy for you. Comcast bought NBC Universal and succeeded because they understood media, had the culture for it, and could integrate effectively. AT&T had none of that. Same industry, completely different capabilities. AT&T treated them as interchangeable. The second lesson: acquisitions cannot fix a fundamental strategic problem. AT&T thought buying content would solve their telecom bundle weakness. Instead, they ended up owning assets they didn't know how to manage in industries they didn't understand. You can't acquire your way out of a problem that requires operational excellence and cultural fit. And the third lesson: never ignore the trends your customers are following. The numbers were screaming that consumers were abandoning traditional TV for streaming. AT&T heard the noise but bet against the trend anyway. That's not vision, that's denial. It's truly incredible how one CEO, operating with good intentions but terrible judgment, can nearly ruin a company that had survived and thrived for over a century. Looking back at this entire saga, if Stephenson had possessed just a bit more foresight back in 2015, he might have seen the giant red flags. DirecTV wasn't necessarily a failing company at that exact exact moment. But in the bigger picture, consumers were clearly flocking to Netflix and Hulu in massive numbers. The growth of traditional television was declining rapidly while streaming growth was accelerating exponentially. The solution to finding himself in that mess was definitely not to acquire another giant television and media company for even more money than the first acquisition. What do you think about how AT&T handled this entire saga? Share your thoughts in the comments and let us know if this changed how you view corporate acquisitions forever.